Yo, what's going on everyone? Welcome to phase A of the course. This video is going to be on smart money trading versus retail trading. As we all have a retail background, we all started with trading with support resistance and stuff like that. And for the people that are making that switch towards institutional trading, this video is specifically made for you to understand the differences between smart money trading and retail trading, how the retail trader is trading, and how, what basically gives us that difference in our ideologies or theologies, whatever you want to call it. So let's start off with retail trading. So the the basics, fundamentals of retail trading is all made by support and resistance. Now we're all told, as we were brought up as traders, to buy at support, sell at resistance, and that's basically how the retail trader is trading. They look at a level of support that's been tested multiple times, and they're thinking about getting in for opportunities at those levels. Buy at support and sell at resistance, and vice versa. And like we all know that this doesn't work anymore. Like it used to work at a certain time, but as we kept on using this type of strategy to buy as support, sell as resistance, the less likely and um, it just became less likely and it didn't work anymore. Now we're also told as retail traders to enter at levels that had more tests. So support and resistance that have a lot more tests, meaning that if for example if there's a level of support and it's been tested at least 5 times, they say that okay, that means that this level is so strong it's been tested 5 times. But what we say as institutional traders is that that's not what it means. It means that the level gets weaker. But to the retail trader, if there's a level of support and resistance that got tested multiple times, it gets stronger and stronger. And I'll give you guys a good example. For example, there's a level of support and resistance. Market tests this level or area multiple times. For example, right here. Now, as this level gets tested more and more, the retail traders are saying, "Oh my God, this level is so obvious. It's amazing. It's been tested. I'll sell here and I'll buy here." Right? But in reality, what ends up happening is they start creating money at the lows. Now we'll get into that for the liquidity video, so don't worry if you don't understand that. But yeah, that's basically how the retail traders are trading. Now that also leads to break and retest. So a break and retest is basically when the market is establishing a previous level of support or resistance, and then we break out of it. And the market or the retail trader says that the next time the market retests that previous level of resistance, that it's gonna turn into a support and then it's gonna continue going up. Now this is completely like wrong. We've all seen this. We've all tried this in the market. Sometimes it works, sometimes it doesn't. It's kind of like gambling because there's no confirmation for it. You're basically just entering off of any break and retest, right? And then we also have the breakout entries that the market creates. So for example, if the market did yeah, right over here, look at this. So the market did end up creating this level of support. We can all see that. Now to the retail trader, we're all told to buy here, right? Because 1, 2, 3, 4, 5 tests at this level, so it's supposed to be stronger. So you buy at this level, and then you get stopped out, right? Now you get stopped out, but then you see the breakout. We're told that if we see the candles close below the previous level of support, that is considered a breakout, and we're supposed to enter right away because the market broke out. So what people are doing now, or what retail traders are doing now, is they're entering on that breakout. They're putting their stop loss above and then TP at the next low. That's which is like a 1-to-1, 2-to-1, but then you do end up getting stopped out. So this isn't a coincidence. This is obviously retail traders getting manipulated around the market. But yeah. Now those breakout entries and break and retest lead to retail liquidity, just like I said before. Now liquidity, don't worry if you guys don't understand this. I'm gonna go in depth about liquidity in a different video, but I'll give you a quick summary. So liquidity is basically money, right? Stop losses. So if there's a specific level in the market that's been tested multiple times, for example, a support, a really, really obvious support, the banks aren't really interested in buying at those levels because they know that the majority of the traders are seeing that level and they're thinking about getting in. So if a million people are getting in at that same level of support, that means that millions of billions of dollars are going to be below that level of support because we all put our stop losses below. So what the banks end up doing is they make price go down to take out all that money. They break the support, they make price go down, and then they reverse it. And just like I showed you right here, it's a perfect example. Right here we have this area of support. The market was tested multiple times, and the banks knew that there was a bunch of money resting below. The banks pushed price down to take out all those stops, and then price ends up reversing towards the upside, right? And that's what we can see. So that's initially what liquidity is, and the way that retailers are trading they're trading where they get stopped out. Now let's move to smart money trading. Now the basics of smart money trading is all backed up by supply and demand. So supply and demand is similar to support and resistance, but instead it's untested zones. So there's multiple zones in the market, obviously, but with supply, we're basically trying to find that area that the market had the biggest push down, that had a ton of momentum, lot of really nice, big, thick, engulfing candles, and there's just overall a lot of sell side pressure. What we're expecting price to come back up towards that same level and test it at least once before we take a sell. So I'll show you guys an example, obviously, but right over here, we're saying that fresh / untested levels are much more stronger. While retailers are saying that the more tested level has, it's stronger, but in reality it's weaker, right? So for us, we're focusing on untested levels while retailers are focusing on more tested levels. And obviously untested levels are way more stronger than retested levels, so that's why supply and demand works really nice, because it's basically focused on getting in those untested levels. Now after supply and demand, we go down to targeting retail stop losses. Now targeting retail stop losses is basically we're getting in when the retailers are getting stopped out. We know as supply and demand traders, or as institutional traders, that we're not looking to get in at those levels of support and resistance. And 95% of the market is consolidation, right? It's basically just consolidation, and that also means that the market is going to be creating tons and tons of levels of support and resistance. Now, because we're smart and we're smart money traders, we're not looking to get in on those specific levels. What we're trying to do is we're waiting for price to break below those levels to stop out all those retail traders, and then we get in. And that's why I wrote right over here, we get in when retailers are getting stopped out. Now, we all know that retailers use these candlestick cheat sheet patterns, like the engulfing, the doji candle, the hammer stick candle, all these different candlesticks. Institutional traders, sorry, we only use one candlestick pattern, and that is a institutional candle. It's not really a candlestick pattern, but technically you could say it is. But basically, this helps us identify the footprints of where the banks are buying and selling. So this leads to trading with the banks, right? And same thing with imbalances. We'll get into both of these later on in the course. You don't need to stress about this, trust me. It's really easy to follow. But imbalances also helps us know where the banks want to take price in the next few months or years. While retailers don't have these kind of tools or understandings of where banks are taking the price. All they're doing is they're just buying at support, selling at resistance. And evidently this leads to us trading with the banks and following their footprints. Now I'll show you guys supply and demand in Forex. It's really simple. Okay, I thought I had an example, but no problem. So right over here, if we're focusing on this major drop, anyone can see that this area had a ton of sell side pressure. Now if I were to draw this zone of supply right over here, you can see that it's untested. First of all, it's untested. Now price comes back up into that level that's untested, tests it once, and then it ends up selling off. Now vice versa for demand, this is a strong level of demand. Price created this area of consolidation and then pushed up with a ton of buying pressure. Now the market comes back into that demand, tests it once, and then it pushes up. Now if you're a retail trader, there's no support or resistance inside of this level. You're not thinking about you're not thinking about getting in on this level because there's no support or resistance here, right? If anything, you're probably thinking about getting in for buys over here, or maybe a break and retest over here, or whatever. But that's basically what differentiates us smart money traders from retail traders. So thank you guys for watching this video. I hope this one was easy to follow, but I'll see you guys in the next one. Make sure you're taking notes, and yeah, take care.